Every year you chase high-yield dividends with your $10,000 nest egg. You might actually be leaving upwards of $200,000 on the table by the time you retire. Sounds wild, right? If you're in your late 20s and looking at your retirement savings, here's a question. What if focusing on dividend income is shrinking your future, not growing it? According to the Federal Reserve, the average American your age has about $10,000 set aside. And Warren Buffett himself says most investors shouldn't obsess over dividends early on. So what's the smarter move? Stick around, because I'm breaking down the real math, exposing a costly mistake nearly every beginner makes, and revealing the simple three-step system that could transform your $10,000 portfolio. The final step is what really multiplies your results, but almost nobody does it. Let's kick things off with reality check. According to the Federal Reserve's 2024 survey, the typical person in their late 20s has about $10,000 set aside for retirement. That probably sounds familiar, maybe even a little discouraging. But here's the real question. What can that $10,000 actually do for you? How much dividend income could you expect to receive from it right now? And is that even the right goal for your age? Most new investors think maximizing dividends is the safe route. But this is the #1 mistake that can cost you hundreds of thousands over the long run. Today, I'll give you the real numbers, show you multiple side-by-side scenarios, and present the 3 steps you can use to turn your $10,000 into the foundation for real financial freedom. Stay with me, because after the breakdown, I'll reveal a mistake even experienced investors still make, and the overlooked strategy you need to multiply your growth. First, if you want more data-driven tips on money and investing, subscribe to Mark Invests and like this video. If you're watching and already worried that your current plan won't be enough for retirement, tap like so I know this is hitting home for you. Now, here are the 3 steps any young investor should follow to grow a $10,000 portfolio faster. Step 1. Understand your true starting point. Before we consider investment options, let's get clear on where you stand. Most in their 20s have roughly $10,000 saved for retirement. With that portfolio size, dividend income will be limited. But by exactly how much? Let's look at the real numbers. Scenario 1, you put $10,000 into an S&P 500 index fund, the most common investment choice. The S&P 500 is popular because it gives you instant ownership of 500 of America's largest, most stable companies. It's diversified across every sector: technology, healthcare, consumer goods, industrials, and historically, it delivers strong long-term growth. Warren Buffett even recommends the S&P 500 as the go-to choice for most investors. But here's the kicker. Major S&P 500 index ETFs currently pay a dividend yield of less than 1.5%. What does that mean for your $10,000? Multiply $10,000 times 1.5%. That's just $150 in dividends per year, or about $12.50 each month. That's barely enough to cover a streaming subscription. If you step up to the Dow Jones Industrial Average, the Dow, your dividend yield edges up slightly, just over 1.5%. So with a $10,000 investment, you might make a touch more than $150 a year. Again, not even enough for your cell phone bill. Now, if you want more dividend income, you might be tempted by something called a high dividend ETF. One example is the Invesco S&P 500 High Dividend Low Volatility ETF, which currently pays around 4%, much higher than a typical index fund. On $10,000, that's about $400 per year in dividends, or $33 a month. That starts to sound intriguing. But don't get too comfortable yet. These types of funds give you higher income today, but there's a big trade-off for your future income. I'll show you why in just a moment. Before I do, imagine Sarah. She's 28, just got her first real job, and puts $10,000 in her IRA. She's heard dividends mean safe money, so she puts it all in the high dividend ETF. Over the next 10 years, Sarah collects her $400 a year, pocketing $4,000 total in dividends. Not bad, right? But here's what she doesn't see. If she'd put that same $10,000 into a growth ETF instead, even at a historical average of just 8% annual return, price appreciation plus a small dividend, her investment could nearly double. And her nest egg would be far bigger by age 65. I'll show you the dollar difference in a minute, but keep Sarah's choice in mind. It's the fork in the road for young investors. Step 2, know your income options and their trade-offs. So let's do a side-by-side breakdown of exactly what each major strategy could pay you today versus what they could be worth by retirement. I'm going to put these numbers in a simple table so it's crystal clear. S&P 500 Index Fund, 1.5% yield on $10,000 means $150 per year, $12.50 per month. Dow Jones Index Fund, 1.6% yield on $10,000 means $160 per year, $13.33 per month. High Dividend ETF, 4% yield on $10,000 means $400 per year, $33 per month. Vanguard Energy ETF, Sector Fund, 3% yield on $10,000 means $300 per year, $25 per month. Vanguard REIT, Real Estate, 3% a yield on $10,000 means $300 per year, $25 per month. Growth ETF, like VUG, less than 0.5% yield on $10,000, less than $50 per year, less than $4 per month. Key, the more you chase dividend yield, the lower your expected portfolio growth. High dividend funds often favor stable, slow-growth companies, which means your money's not compounding as quickly over time. For older investors, that's a fine trade-off for steady income. For younger investors, it's a costly mistake. Here's the proof. Let's rerun the numbers. But instead of looking at just today's income, let's fast forward to retirement at age 65 and see the total value. Imagine you invest $10,000 once at age 25, never add another dollar, and reinvest all returns. If you earn 8% per year, your portfolio grows to $217,000 by age 65. Using the formula, future value equals present value times 1.08 to the power of 40. $10,000 times 1.08 to the 40th power equals $217,245. If you get 10% a year, possible with the right growth ETF and some luck, you end up with $452,000. That's right. Just a 2% difference more than doubles your result. But high dividend yield investments usually deliver a lower overall return, maybe 6%. Use the same formula. $10,000 times 1.06 to the 40th power equals $102,857. That's less than half as much by retirement, all from chasing short-term income over long-term growth. Now, here's the emotional punch. By focusing too much on dividends in your 20s and 30s, you may be picking up small payouts today, but missing out on hundreds of thousands in future wealth. Drop a comment below if you've ever wrestled with dividend versus growth confusion. What's your biggest question about investing for income versus growth? Let's go back to our comparison. Is there ever a right time for high dividend investments? Yes, but usually much later. When you need income to cover expenses and have already built a large nest egg. Until then, you're likely to get far more value from growth investing. That's why Warren Buffett recommends ignoring dividends at the start, and why. According to Vanguard, growth-oriented portfolios outperform income portfolios for most investors under 50. Just for clarity, let's summarize the monthly income and 30-year value for each. S&P 500 Index Fund, $12.50 per month income today, $217,000 by age 65, if averaging 8%. High Dividend ETF, $33 per month income, $103,000 by age 65, if averaging 6%. Growth ETF, $4 per month income, $452,000 by age 65, if averaging 10%. Sources: Federal Reserve average savings data, S&P yield data from Vanguard, long-term U.S. equity return assumptions. Let's visualize this. Imagine an on-screen bar chart showing the 30-year growth difference. The high dividend fund is slow and steady. The growth ETF shoots up dramatically. Step 3. The smart switch growing first, then pivoting to income. We've talked a lot about what not to do. Now here's your actual 3-step blueprint. 1. In your 20s and 30s, invest primarily in broad-based growth ETFs, like Vanguard Growth, VUG, or the S&P 500, focusing on long-term appreciation. Don't obsess over tiny dividend checks. 2. Ignore income payouts early on. Let your money compound. Automate your investments and reinvest any small dividends you get. Aim for the highest reasonable growth rate instead of a higher yield. 3. When you get closer to retirement, typically 5 to 10 years away, consider gradually moving some of your portfolio into high dividend funds. Sector funds like REITs or dividend aristocrats. That's when income, not just growth, becomes your priority. By following these steps, you're likely to end up with a nest egg several times larger than if you'd fixated on dividends. Well, from the start, the extra growth is what yields major peace of mind and a much higher spending power in retirement. Comment growth if you want your portfolio to snowball for the future, or dividend if you're looking for income right now. Let's see which camp wins in the community. Before we close, a couple of keynotes. Pattern break. Let's revisit Sarah's story. Remember, she went for the high dividend income, and after 40 years, her $10,000 portfolio grew, with dividends, to about $103,000. Meanwhile, if she'd bet on growth, she could have ended up with $217,000 to $452,000 instead, enough to radically change her financial future. That's not just a difference of a few bucks a month. That's the difference between scraping by and living comfortably in retirement. Here's the quotable summary. Chasing high dividends as a young investor is like picking up pennies in front of a steamroller. You get a little now, but you risk missing out on hundreds of thousands later. So, what should you do next? First, make sure your $10,000 is in a low-cost, growth-oriented index fund or ETF. Think Vanguard or Fidelity. If you're not sure how to get started, you can try out free tools like Personal Capital or use my dividend versus growth calculator. Check the link in the description to run these numbers yourself. Second, automate your contributions. Even if it's only $50 or $100 a month extra, over time, regular investing makes a huge difference thanks to compound interest. And finally, review your risk tolerance as you get older. When you're about 5 to 10 years away from needing income, that's when you may want to shift into higher yield, more stable investments. To sum up, don't make the all too common mistake of obsessing over dividends in your early investing years. Focus on the growth. Let it compound. Then pivot to income when you actually need it. If this helped clarify things for you, don't forget to like the video, comment your biggest question below, and subscribe for more practical investing breakdowns. And remember, download the free dividend versus growth calculator in the description. It'll help you see exactly how your $10,000 could grow with each strategy. One last thing. This video is for educational purposes only and is not personalized investment advice. All the examples are hypothetical, and returns are based on historical averages, not guaranteed for your situation. Please do your research or talk to a financial advisor before making investment decisions. Thanks for watching Mark Invests. I'm Mark, and I'll see you in the next one, where we'll break down which index funds have the best historical returns for new investors. Let's wrap up by reviewing your action steps. 1. Invest your $10,000 in a low-cost, broad market growth ETF like Vanguard Growth or an S&P 500 index fund. Avoid chasing big dividend payouts. 2. Automate and increase your contributions consistently, letting compounding do most of the work. 3. Reassess your needs as you move within a decade of retirement and begin shifting funds gradually to income-based investments only when you truly need steady income. Use verified tools like Personal Capital or download my free dividend versus growth calculator. Link below to test exactly how fast your money could multiply across different strategies. If you start today, you'll see your first results within months. But the real magic is in the decades of growth, with those first $10,000 growing to potentially $217,000 to $452,000 by retirement with the right choice. If you're ready to take control of your financial future and stop falling for common investing myths, hit subscribe to Mark Invests. Next week, I'll reveal the best index funds for first-time investors with a full historical breakdown. Drop your top question about dividends or growth strategies in the comments. I personally respond to the first 25. And don't forget to grab the free dividend versus growth calculator to simulate your plan. It just takes 2 minutes. Remember, this channel is about community, learning, and building real wealth together. This video is for educational purposes only and is not personalized investment advice. Returns and examples are hypothetical and based on historical averages. None are guaranteed for your unique situation. Always consult a qualified financial advisor before making real investment decisions.